Welcome to today's call, everyone. My name is Michael Wilson, and I'm going to be your host today. I'm sure you're familiar with the Zoom technology, but in case you're not, I'll take you a brief moment just to explain what's important before we begin. There are several hundred dentists across Canada attending today's call. I placed each of you on mute, and I would ask that your lines remain on mute for the duration of the presentation to avoid any background noise impacting other attendees, and I'll thank you in advance for your cooperation. The presentation today has two parts. There's a formal portion to kick it off with Bill and Mark speaking, which I'm going to attempt to limit to about 25 minutes of our hour together, followed by an informal question and answer period. I invite you to submit your questions using the Q&A button on your Zoom screen at any point during the presentations. I will do my best to get to each question during our time, but given the number of attendees, I think we're going to run a little short. It is important to Bill and Mark that you get the information you need to make good decisions quickly given the unprecedented disruptions you are facing. I have provided Bill and Mark's cell numbers. They're on the screen now. Their emails. I invite you to contact them either by phone, text, or email after the presentation should we not get to your question in time. I'll put the contact information up once again at the end of our call, but I would encourage you to take a screenshot now or jot down the information so you have it later. And so with that, I think we can begin. It goes without saying that our thoughts are with the family and friends directly impacted by COVID, and we are grateful for the frontline workers tirelessly fighting for a positive result. Today's conversation is another important second order effect of COVID, namely, it's the impact on practice values and retirement plans. Bill and Mark have a lifetime of experience in these areas, and they're here to share their knowledge and experience with you. I imagine most know Bill and Mark from their firm's many years of working with dentists. Bill is the president and principal partner at Tier 3 Brokerage Limited, one of Canada's leading dental practice brokerage companies. Tier 3 manages over 50 million in practice transitions annually for dentists through their reps across Canada. Later in the presentation, Bill will be sharing his insight that Tier 3 has gathered from its database of practice sales over the years, helping everyone better frame where practice prices might head both in the short term and long term. Before we do that, I thought it would be helpful for Mark to quantify the dilemma facing most transitioning practice owners today. Mark is the president of McNulty Group. McNulty Group is responsible for managing 400 million in dentist retirement savings and has been doing so since 1982. He is the author of multiple books, the latest being the 6 Million Dentist Successful Succession in 8 modules. So remember, please submit your questions using the Q&A button on your screen. And with that, enjoy the presentation. Mark.
Thanks, Mike. I want to go to the first slide there. So again, I'd encourage everybody to submit their questions. Bill and I are both available after the call. Mike has put up our contact details. The crux of this presentation or webinar is to talk about all of the unknowns and maybe try and fill in some of the blanks that we're all facing right now. There's still a lot that we don't know about what's happening in the world. So I'd encourage people to take down both Bill's and my contact information, and feel free to contact us at any time so we can continue to share information. What you're seeing up on the screen right now is the typical life cycle of a practice owner. And if anybody's heard me speak over the past maybe 5 to 10 years, they've seen this chart. A dentist typically enters, we work with, at McNulty Group, we work with 108 families. 104 of those are dentists. We manage $400 million for those people. And all but, I think it's 6 or 7 have now sold their practices. So we've been through a lot of practice sales and transitions. And this is the typical life cycle of a practice owner in our experience. A dentist typically enters practice ownership in their 30s and retires and sells their practice at age 62. They typically don't start getting serious about retirement planning until their mid 50s, when they wake up one morning and realize that this retirement thing's actually going to happen to them. And that's because if the average dentist we know sells their practice at age 62, by age 58, they start living their retirement plan. And then I'll talk a little bit later about the initial 5 years of retirement after they sell their practice, which brings us to age 67. The current crisis has put a flaw in this typical life cycle. And what I want to do is share with you today a actual case of a dentist who's in this situation of selling their practice and retiring today. And I want to compare our assumptions and what they used to be and what they are today with the information we now have. Mike, why don't we go to the next slide? So this is a client of ours who sold their practice at the end of 2019 and on January 1st started receiving their retirement paycheck from their portfolio. Now, I'd encourage you to ask questions about the numbers that are included here, but I'm going to try and give you a brief synopsis, because what I'm going to do today is take you through this actual case study and assume that it happened right now, post-COVID, as opposed to in 2019. So what we're looking at is, as is typical, and that's why we use this case study, is this dentist sold their practice and retired at age 62. Including their practice value, they had just under $3.2 million. And that translates into retirement spending for the rest of their life of $165,000 a year, or $13,750 a month after tax, indexed for inflation, for the rest of your life. That number, 13,750, is very important because our firm's entire success is dependent on being able to maintain that number. So when we quantify a retirement plan for a dentist getting ready to sell their practice, making that massive decision, we have to be right. Because if that number's wrong, our client is going to outlive their money. So we need to be right, which means we need to be conservative in our assumptions. So what actually happened in this case is the dentist retired, and you can see they have about just under 1.2 million in RSPs, about 380,000 in their corporate savings. That's a little bit different than normal. People typically have a little bit more money in their corporation, but all the same, they have a similar amount of tax deferred money. And then they have the practice value, which is typical, is close to half of their entire portfolio. So that the practice value changing has a major impact on a dentist's retirement. So we have, when I tell you that we have all of our firm's success is based on us being able to maintain that monthly cash flow that we commit to for the rest of a dentist's life, we've been able to do this through the crash of 1998, through the tech bubble bursting, through 2008, another decline in 2016, 2018. We have never had to change a single client's cash flow as the result of a stock market decline. And I'm going to explain a little bit later why. But if I was starting this person out today and they came to me and said, I want to sell my practice right now in the midst of a COVID decline, a COVID-induced decline, here is what my assumptions would be. Mike, why don't you go to the next slide? Now, this is not a prediction of what's happened to practice values. This is a retirement planner saying that I have to be as conservative as possible in the assumptions that I use so that my client doesn't outlive their money. And so this is the exact same dentist but instead of selling their practice at the end of 2019, they're selling today. And if a if a client was selling today, I would tell them, I'm going to suggest that we plan for a decline of 30% in your practice value. So your practice value just went from 1.55 to 1,085,000. That's a significant decrease of 30%. In addition to that, your retirement assets in your RSP, your savings in your corporation and your RSPs have declined by 10%. So now we have an asset base of 2.5 million, which I think you'll all agree is a pretty severe discount from where we started in the actual case at the end of 2019. So now instead of spending $165,000 a year, this dentist can spend $138,000 a year. And the amount of money that we would be protecting, or the monthly cash flow that we'd be willing to protect and to commit to, is $11,500 a month after tax. Still a nice number and still gonna be a nice lifestyle, but that's a massive hit to their finances when they're getting ready to retire. And there are people out there who are in this situation. So Bill's going to talk about what's actually happening in practice values. But from a financial planning standpoint, we need to be prepared for practices to be down as much as 30%, and for portfolios to be down as much as 10. Now that's if it was going to happen today. Mike, let's take a look at what if it happened in 2021 on the next slide. In 2021, I think we can safely say that practice values are going to begin to normalize. We don't know the trajectory of, there's still a lot of information we don't know. We don't know the trajectory of the virus, obviously. We don't know what's going to happen when practices open up. But we do know that there is still demand out there for dental practices, and Bill's going to talk to that. So if I was trying to be conservative and selling in 2021, I would then reduce the 2019 practice value by 15%. And I would assume that the retirement assets in 2021 are back to 2019 levels. In other words, they haven't gained anything. There's been no investment return, but they're no longer in a loss position. In this same scenario, the retirement spending for this client drops to 155,000 instead of the current 165,000. And then by 2022, I'd assume for any one of our clients that we're planning on selling, that we are back to 2019 practice values, and that we have a small gain in the retirement portfolio from where it is today. And so there's two good things that happen if you defer selling. If you were selling today and you defer selling until 2021 or 2022, is that you maintain ownership of the practice and continue to fund your lifestyle. So there's less of a drawdown on the portfolio. So in fact, in 2022, this dentist can actually spend more than they could if they retired in 2019. That's the breakdown and a case study of where I see things from a conservative retirement planning perspective. But Bill, I'm going to ask you what is actually happening from a practice valuation standpoint, because I'm all over the map. I'm hearing all kinds of things. I've heard that practice values are up, and I've heard from other people that practice values have absolutely crashed. So why don't you let us know what you're seeing at Tier 3?
Thanks, Mark. And let me begin by saying that Mark and I have been doing presentations together for how long, Mark? About 8-10 years now, maybe?
That's right, yeah.
For 10 years now, he's had to have a look at me present what's happened to dental practice values in the marketplace. And I know he looks at that and goes, oh my God, Henderson, I'm not managing the practices, but the practice is outperforming the stock portfolio I'm managing. So he's just loving this chance to talk about the downside. The good news is that the reason Mark's such a successful wealth manager for people and financial planner is he is conservative. And I'll begin right up front by telling you that a whole lot of things would have to get a whole lot worse than they currently are for his conservative assumptions there to be broadly what's going on in the marketplace. But that is the way to plan, because none of you get a chance to rerun your retirement plan if it doesn't work. So let me give you my perspective. Mark, your lead-in was perfect. There are a ton of mixed messages out there. I've been on, like all of you, I haven't been on as many webinars as you have, but I've talked on them, I've listened to them, and I'm talking to people in the industry every day. Here are two quotes I've heard in the past week. One brokerage, I'm sure many people on the call tuned in to something they did on the weekend, where one of the presentations was entitled "Practice Values Didn't Decline During the COVID-19 Pandemic." The use of the past tense there would imply that the owner of that brokerage owns a DeLorean with a flux capacitor. That's a Google the reference if you didn't get it. But clearly their perspective is values have remained as strong as they were. I was on another one and then talking to a representative from one of the corporate group buying groups, also known as dental service organizations. And that aggregator told me, hey, Bill, the days of high valuations are over. You know it, I know it. Earnings and earnings multiples are going to be much lower going forward. You couldn't get two more diametrically opposed points of view, and I don't agree with either of them. Although I agree with a lot of the underlying points they're making. And the reason I don't agree with either of them is there's no time boundaries on those statements. And you know, whatever I tell you in terms of the value of a practice today, we could have an announcement out of the RCDSO this afternoon, or your provincial regulator. We could have a scientific discovery announced tomorrow in Germany that will make whatever I'm telling you today invalid. If we move to the next slide, the reason for that is this. We are dealing with an unprecedented level of uncertainty. We've never had more uncertainty in the marketplace. And over time, we're going to move from this extreme uncertainty. I never know if it's reversed or not with the way you're looking at it, but we're going to slide down that uncertainty curve while confidence ramps up. The curve is, you know, it's not going to be a smooth ride. Those lines are smooth. They're going to be bumpy. But over time, we're going to learn more and more. And as we learn more and more, we're going to transition from the situation we're in right now with respect to practice values to the situation that will be the new normal. The new normal may be a lot like the old normal, but it's going to take us a while to get there. And I'm not here to tell you if that's going to be in 3 months, 12 months, or 18 months, but we will get there. The key is we're learning each and every day. And so what I want to give you is a framework to think about value, so that when you wake up tomorrow and you see an announcement from a regulator, or you hear something from a colleague in Australia next week, you can kind of think about what the impact is. So where are we at right now? Michael, if we move to the next slide. The best way to think about the value of practice, there's many, but the most succinct way to think about it is the value of your practice is a function of the earnings, which is revenue minus costs. You need to factor in there paying yourself to be the dentist when you're looking at the earnings, times an earnings multiple. And an earnings multiple is simple. If there's $1 in earnings and the earnings multiple is 6, somebody will pay you $6 for that dollar in earnings. Many of you have heard the term EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Now we have to add coronavirus in there. Because we all know it's easy enough to look at what your EBITDA was before coronavirus. One day we'll be looking at it after coronavirus. But the key thing is what's going to be happening to earnings, what has happened in the last 8 weeks, and what's going to happen in the coming months. So let's look at where we're at right now. Michael, next slide. This is a complicated slide. Grab a photo with your phone if you want, or email, I'll send it to you. But this breaks down those two drivers, earnings and earnings multiples. And you know, the conclusion down at the bottom of the slide is, yeah, earnings are lower right now. Heck, you're all sitting at home on a Thursday afternoon watching a webinar. Your revenue isn't what it was pre-COVID. And it's going to be a while until you ramp back up. And there are enough buyers sitting on the sidelines right now that I'm not going to pretend multiples today are as high as they were. The key thing is it's not your current earnings that will determine the selling price of your practice. It's a purchaser's expectation of future earnings. And as we move down that uncertainty curve and up the confidence curve, they're going to be looking at the things on the left-hand side of your slide. We know revenue's down. We do not know how quickly it will ramp up. That said, we are starting to learn. I put the slide together, first of all, about a week and a half ago. Since then, I've started down the uncertainty and up the confidence curve. I'm fortunate to be part of an international group of brokerages, and we're meeting once a week right now to share experiences from around the world. And other parts of the world and a few provinces here are starting to open up. And as that happens, we're going to gain confidence. I can tell you that in the US, many states, there are a bunch of states that have opened, some with restrictions, some without. The first week of data is now in. There was an ADA webinar, heck, most of you were probably on it yesterday, where they reported that, hey, even in those states, in the first week, a third of the practices were closed. But of the ones that were open, 40% were reporting patient counts that were at least 50% of pre-COVID levels, and many higher than that. 13% were reporting already being at or above 75%. Now, to my point about uncertainty, and it's not a smooth line, that's 1 week of data. It's claimed data. They'll have 2 more weeks in the webinar they do in a couple of weeks. We're going to learn more then. I was on the call with a guy from Australia today. They opened on Monday. He's going to have some data next week for us. Spain and Italy have begun reopening. The reports there are that revenue, not patient counts, are in the 50 to 75% more of pre-COVID levels. So I don't want you to take any of that as anything to be overly confident in. It's all very encouraging to me. My point is we're going to know more and more about that stuff on a weekly basis. So short term, definitely revenues are down. How quickly they get back, we will see. You've got a backlog of treatment, and that's going to help you. The one thing I hear a lot of people saying that I want you to listen carefully to right now is a lot of people are worried about the impact of the recession we are now in on discretionary dental spending. I don't think I have a conversation where somebody doesn't raise that. History has a lot to teach us in this regard. Mark, you commented that we've been through, you've managed money through many recessions, the one in 81, the one in 91, the 2008. Mm-hmm. Those of you who own a practice, if you've still got your old financial records, please pull them out of the filing cabinet. Look at what happened to your revenue in that time period. Because if you are like the vast majority of dentists, your revenue was flat to up. Dentistry as a profession is remarkably recession-proof. And you don't have to take my word for it. You don't have to take your personal experience. Those of you in Ontario, pull out your latest ODA economic report to the profession. On page 11, there's a graph. It shows you that dental revenue from 2008 through 2011, that's how long that recession lasted, never declined below 2008 levels. I'm not here to tell you it'll be the same this time. I'm just here to tell you there's some data out there that you need to balance with what you're hearing. But we all know your costs are going up. Short term, buyers are on the sideline to some degree. Now, we closed the deal literally yesterday, so it's not like you can't sell a practice, but I'd be misleading you if I told you that you could sell it today as easily and for as much money as you could have in January. Next slide, because the big question is where are we headed? Because people will buy a practice based upon the future more than the present. The future is a lot more positive. Yes, there will be some ongoing cost increases to your practice from infection control and protection. Until the regulators have voiced a point of view on future sustaining dental practice protocols in that regard, we don't know how much. In the modeling we've done, most of it, likely all of it, should be recoverable with fee guide increases. And having talked to a few of them, most of the provincial associations are looking at that already very actively. So, we're scanning with that international group, the protocols around the world. The majority of the places around the world that are reopening, yeah, there'll be a IPAC hit on your cost structure, but it's in the 2 to 4% range once you're at a steady state. Plus, you got a lot of patients who will need to get caught up on delayed treatment. And that treatment delay means they're going to need more extensive work in some cases. So we think future earnings flat, maybe some downward pressure. But the supply and demand picture that drives earnings multiples, it's all positive. Yeah, there are a bunch of fed up dentists who are going to decide this is it, they want to sell. But there are a lot who weren't invested with somebody as skilled as Mark, and they can't afford to sell because their stock portfolio took a big hit. The demand picture is all positive. Interest rates are now at effectively the lowest level they've ever been for purchasers. I was working with a buyer this week who got confirmed financing from a bank for once we can reopen practices. That's the key. At prime minus a quarter. Prime today is 2.45, so that's 2.2% interest rate, amortized over 12 years at full appraised value with a line of credit that would allow them to go above the appraised value.
Wow.
Interest only for the first year. Now, unusually strong buyer, and that was from 2 banks, by the way. So the people who are saying banks aren't financing, that's largely true today, although we did have the one close. But the banks are highly competitive. Collectively as a group, the dentists out there are one of the single best investments a bank makes. Default rates on dental loans, and if you're on the Shine webinar I did weeks ago, the banker I was on it with said, hey, 0.1% on an ongoing basis. They make a fortune on your merchant banking fees. They love to do your wealth management. They will be back. They will be back strongly and competing with each other as soon as we've got more certainty. There are going to be too many buyers, and there are going to be more buyers. One of the things I heard on the weekend on the webinar from one of our esteemed competitors was they've had a jump in the number of buyers registered with them. We have too. We've been running buyer registration longer than any brokerage in Canada. We've got over 5,000 people registered with us. Lots of them bought a practice years ago and never took their name off our list. But the rate of new registrations, this is people who want to find out about practices that are for sale or coming for sale, that rate has doubled in the last 6 weeks on a weekly average basis compared to the run rate pre-COVID. Associates are worried about their future. They know that if we start up slow, owners are going to prioritize their own bank account, which is badly depleted, ahead of the associate. And so they're registering to find out about practices. So supply and demand is all positive going forward. And therefore, selling prices will rebound nicely. I will bet. I've got one steak dinner bet on it. Anyone else on the call who wants to bet a steak dinner or your food of choice, I will. Next slide, Michael, and then I'll turn it back to Mark. So where are we at? Hey, if you're selling 3 to 10 years from now, relax, take a deep breath. You're going to be fine. Supply and demand is on your side, and the laws of economics have not been repealed by COVID. To the extent you don't agree with me and you think IPAC may be an ongoing cost increase that you can't recover, then you're going to need to place a bit more focus on earnings. This is an entirely self-serving comment. I understand that. If you're worried about that, get a practice appraisal done. If not by us, then by one of our many capable competitors. Because a good appraiser is going to tell you, if you don't get 3 to 5 ideas for building the earnings and profitability and value of your practice, you didn't get what you paid for. So get a game plan in place now if you're worried. They can be updated going forward. You've got time in your hands to do some of that right now. Those of you selling in the next year, it's not quite as rosy for you, but there are still lots of buyers. The more time goes by, the more certainty we're going to have. But we've got 8 deals right now that went on hold going into COVID. The net drop in value in those deals averagely is about 8%. So if you want to, Mark's planning 30% down. If you had a gun to your head and had to sell today and it wasn't a desirable practice and had to close before COVID, that may not be a bad number, Mark. But the deals we've got that are scheduled for closing once we're out of COVID, currently 8 to 10%, but none of them have closed yet, so none of them are definitive. And they're all but one are still above appraised value. The key thing is have a great plan in place to get back to business. People are going to be looking at your revenue on a week-to-week basis as we come out of this. So have a great plan in place. And definitely the more buyers you can bring to the table, either using a broker that specializes in that or on your own, the more buyers, the better you'll do, because there's a wide range of reactions and you've got to be able to play people off against each other to get the right result. So that's it, Mark. I believe the probable, not the conservative planning basis, is long-term values about the same. Short run, starting at a -8 to 10 and climbing up based upon how quickly we move up the confidence curve.
I couldn't agree with you more, Bill. I appreciate the data. If you go, Mike, to the next slide, I want to talk a little bit about this. There's a picture of, I don't know if I've shown you this before, Bill. There's a picture of Dr. Cameron Ellis. He's from Carleton Place, sold his practice a couple of years ago. He gave me permission to use this photo because this was an invite to his retirement party. And
he does have bathing trunks on behind your side there, right?
I promise he does. But I thought it was the perfect picture of a visual of what it's like to sell your practice. We need to get this right, which is why I'm so conservative in my assumptions, thinking that if we were selling this year, we'd take a 30% hit. Focusing, I want to give people a little bit of information about that. This is not Dr. Ellis's number. This is that case study I showed you for the dentist that's retired in 2019. I told you that in history, in every stock market crash, we've never had to change that number. And I wanted to give some people some tips on what to focus on in order to have that level of success themselves. Mike, if you could go to the next slide, please. This is Dr. Smith that we talked about, who retired in 2019, who sold his practice in 2019. Bill, I think you actually sold the practice. But anyways, January 15th, 2020, this doctor receives a deposit into his bank account, what we call the retirement paycheck of $13,750. Fast forward a few months and the stock market has crashed. This is not a surprise. And again, if anybody has ever read anything, any of the work I've ever done or attended any of the talks I've given, we have always said it is not a question of if the stock market is going to crash when you're retired. It's a question of when. And to combat that and to make sure that when we tell somebody that they can afford to spend $13,750 for the rest of their lives, to combat that, we put in place what we call the 4-year rolling reserve. And I'd encourage people to reach out to us. I was reviewing for this presentation a series of articles that I wrote in 2019. And there's some more information that you can get, and please reach out to us. And I wrote these for the Ontario Dental Association's Journal. We can email these along for some more detail on some of the things that we talked about. Bill, I know you put together some great articles last year, and I've actually had a preliminary preview of an article you have coming up as well. So I think they should probably reach out to you to ask for those articles. Mike, if you can go to the next slide. So the 4-year rolling reserve, if our client's spending $165,000 a year after tax index per inflation for the rest of their life, we set aside 4 years of that in guaranteed short-term instruments. What that ensures is that the money that's invested in the stock market has time to breathe. A stock market crash happens. The reason we use 4 years of reserves, there's almost no period since 1950 where the stock market would have remained in a negative position after 4 years. So what that allows us to do is in 2008, the stock market crashes 40%, we take one of those 4-year reserves. 2009, the stock market's still not back. We take a second reserve. 2010, things have started to recover, and we're able to start replenishing those reserves. We never have to touch money that's in the stock market in order to finance your lifestyle. In order to protect spending of $13,750 a month, you need to be invested in the stock market in order to outpace inflation. Interest rates are too low in money markets and in bonds and GICs to outpace inflation. But just because we're invested in the stock market doesn't mean that we need to be aggressive. It doesn't mean that we need to be invested in stocks that are going to drop 50%. And even if we do have any of those holdings, we can be sure that the 4-year reserve will allow the rest of the money to breathe. There are a lot of people who are considering retiring right now. I can tell you that because just based on the dentists that I still work with that are still associating. They've sold their practice and they're associating their practice. They don't want to go back. They don't want to learn the new normal for dentistry with all of the PPE. So there are going to be some dentists that are retiring. There are some dentists that want to sell. And they were planning on selling their practices in 2020. My recommendation to those people is to get your plan in place today. I suggest you get a practice valuation. Tier 3 is tops, in my opinion. And I suggest that you get a plan in place to get ready to sell. At some point in the next 12 months, you should be in a position where we'll be able to get the same value we would have gotten in 2019. And we should be able to achieve the same retirement cash flow you would have received in 2019. With that, Mike, I'm going to throw it back to you.
Great. Sorry, I was just unmuting my screen here. So that concludes the formal portion of the presentation. I will open up the floor. Just as a reminder, you can submit your questions through the Zoom technology using the Q&A button at the bottom of your screen. I'm going to take a quick pause here to allow people to submit their questions. But there were a couple that did come in during the presentation, and I think
Mike, can I ask you to put all of us on the screen instead of the presentation? Is that possible?
Yeah, of course. Sorry. One moment here. There we go. How's that?
That's great. I like to have a good view of Bill.
Oh, yeah, right.
All right. So first question here is actually for Bill. I don't want to sell my practice to a corporate buyer and have to stick around for 5 years with an earnings guarantee hanging over my head. But on the Dental Corp webinar, they said that they have 300 million on their balance sheet to buy practices, and that individual dentists will have a hard time getting financing from banks. The question is, will I be able to sell to an individual price?
Thanks for that question. And in various permutations, I hear that a lot. They do have a lot of cash on their balance sheet. What they don't say is they've got a huge amount of debt on their balance sheet, and it's very expensive debt. I am told their financing is costing them LIBOR plus 3.75 on the first tranche, LIBOR plus 7.75 on the second tranche. So the key thing to understand is individual buyers are going to be getting money at 2.2 to 2.45%. Their financing costs are lower than the big corporate groups. For some of you, selling to a corporate group will make a ton of sense. Just make sure you get the right price. But they're under financial pressure and have financial constraints that the buyer I was dealing with earlier this week is not under. I believe, time will tell, that we're going to see a bit of a shift back towards individual owner-operators who can invest sweat equity. They don't have to pay themselves 40%. They can pay themselves 30 or 35% and invest some of that in additional purchase price. So, people think we don't sell to the buying groups. We do when it's the right solution for our clients, and we've done some great deals for them. But you'll be able to sell to who you want. And if anything, the individual owner operator is going to be at a better position, I believe, 6 months, 12 months from now, than the bigger groups.
I'll comment on that as well. I have heard from clients that they've been told the corporate dentists pay higher prices for practices. That has not been my experience in looking at offers that my clients have received. I don't know if you've experienced the same thing, Bill, but that's a common question I get: is are the corporate dentists going to pay more, give me more money for my practice? And my answer is no, typically.
Yeah, and my answer, I always say it depends. There are a few cases where that might happen, but they've got strings attached, and you got to be very careful about the strings that are attached. Often the reason to sell to them is more lifestyle based, and the fact you want to continue to work for 3, 4, or 5 years. No, by and large, prices are set by the individual owner operator in our experience, based upon how we handle sales, where we're getting good competition from all the buyers out there. But I don't want to say that's not a route for some of you on the call or on the webinar. Just talk to an expert who can give you some good advice on how to approach it if you think that might be what you want to do. And there are, I told you earlier, we've had a doubling of the number of first-time buyers registering with us every week for the last 6 weeks. What else do you have there, Michael? Give Mark one. I don't want to be on the hot seat the whole time.
Sure. There's a question here. I'm going to meld a couple questions together here, Mark. The first question was, how much cash are your average clients holding right now? And as part of that, they were wondering whether the projections you showed with Dr. Smith, whether that included the house or any liabilities attached to the house or the cottage.
Yeah, good question. That's a question I'm asked at every talk. Bill, you could probably answer for me. You've heard it so many times, but all of that 13,750 or the $3.2 million, it never includes any personal use real estate. So the 165,000 in spending for that client, we never touch the house. That's in a worst case scenario, something bad happens later on in life. That's when you could always tap into the equity in the house, but we don't ever plan to use the money from the house. The other question, Mike, you said was how much cash is our average client sitting on right now?
Yeah, it was related to the 4-year reserve.
Oh yeah, so yeah, the 4-year reserve is based on a client's lifestyle spending. So that would be different for every single client. So if you're sitting, if you're spending $100,000 a year after tax, we'd probably be sitting on $500,000 in short-term instruments in cash. And the reason it's $500,000 is, keep in mind, when we're sending $100,000 after tax, we have to still pay for the tax. So once a quarter, we have to send money to the Receiver General to cover the client's taxes.
Great. Bill, there was a question here. What is the earnings multiple now, and how do you determine the earnings multiple?
We could spend a long time on that because it's going to vary from type of practice to type of practice. It's going to vary by region across the country, the size of the practice, whether you're a specialist or not. And it also, I've got 2 questions that popped up on the screen. Somebody said, hey, I thought you guys were all about the patient count and the hygiene program. And all of those things go in together to determining what's actually going to happen on any one practice. To not avoid the question entirely, in major urban centers across the country, for the most part, earnings multiples coming into COVID were probably in the 5.5 to 7 range. And I believe we will be back there. But it's so situationally dependent. You know, a practice there where revenue is going like this and patient counts are going like this, the trailing EBITDA is not as predictive of the future. If you've got a dentist with patient counts are so important because you can have two practices opposite corners of the same street, both with 1,000 patients, one billing $1 million, one billing 350,000. Obviously, those practices won't bill that in the hands of a new dentist. So, but quick answer, 5.5 to 7.
You know what? One thing that occurs to me that I didn't mention in the formal part of the talk is a little bit about the stock market. Well, one of the things, so I'm saying as a retirement planner, I'm saying that, you know, practice values, I would in a retirement plan say they're down 30%. Bill's saying that there's not a ton of data right now, but you know, it might be down 8%. Think of that as the stock market as well, because what we're both saying is a couple of years from now, we expect earnings to be back to normal. After every recession, after each recession, on average, it takes about 2 years for profits to get back to normal. So we've had this stock market crash. We'd expect profits to get back to 2019 levels sometime in 2022, 2023. That would put our valuations of stocks back to all-time highs. So as consumers, or as investors rather, we have an opportunity to buy at a time when everything's cheap. I'm not saying that we have all of the information we need right now, so we wouldn't just go throw money into the stock market. We have to be very careful. Keep in mind, just because you invest in stocks doesn't mean that you have to. You can still be conservative investing in stocks. Sorry, Mike. I interrupted you there. You've got more questions.
Yeah, I got one here for Bill again. Will evaluation completed today based on the 2017 to 2019 data show a reduced value, even though the sale is planned for the end of 2020, early 2021?
That's a great question. And there's another one I saw here. If I had a valuation done in the last year, does it need to be updated? What we are doing right now is we are basing valuations on results through February 29th. So we're essentially right now doing pre-COVID valuations. The reason for that is go back to I'm not asking you to do this, Michael, I'm asking the audience to mentally go back to the uncertainty and confidence chart. I don't know how your projected cash flow, your projected EBITDA is going to look for the next month, 12 months, or 10 years. And I need that to effectively value your practice. So what we're doing right now is we're doing valuations of pre-COVID values, and we're offering a no charge. This is not what we normally do, but a no charge update to that valuation at any point you choose in the next 12 months. Because I know that over that 12 months, uncertainty is going to wane, confidence is going to build, and I'll be able to give you a much better value. So what we're trying to do is be able to give you a good understanding today of strengths and weaknesses in your practice, what the opportunities are, what you're doing great that you don't want to mess up. And then we'll update it once we all know more about COVID. That's if somebody has to sell today, well, obviously we'll have to tackle it a bit differently. But for somebody who's selling in the next year, that's how I'd approach it. And it will allow us to deal with the fundamental reality that this afternoon or next week, we could hear an announcement that dramatically changes our point of view about earnings and ramp ups and all of those things.
Great. Just a time check here. We're about 10 minutes to 2, so we'll continue to take questions, but we're approaching the end of the presentation. Question for you, Mark. Again, I'm blending a couple questions together. This one, I'm entering my retirement phase of life, still associating a few days a week. My portfolio has 25% stocks. I'm concerned about the market may not recover and I will lose that 25% if the market crashes further. That would be the remaining 25% that's still invested. If the stock market, where do you see this ending? Do you think I should hold on for the long run, or should I just take the loss?
That's an interesting question. I'd have anyone that tries to answer the question of when they see this ending should immediately lose credibility with you. They don't have any idea, and neither do I. So what I do know is I can't comment on 25% stocks because I don't know what types of stocks they are. Let me be clear. We cannot, the diversification abilities in the stock market are endless. I can be buying, Royal Bank, or I could be buying some Taiwanese semiconductor company, and everybody calls it the stock market. So if you have 25% stocks, I don't know what types of stocks those are. What I can tell you is that there are businesses that are going to get through this pandemic and this crisis. And on the other side of this, are going to be in incredible shape. So this is entirely a stock picker's market. What I mean by that is you need to avoid companies that have the potential to go bankrupt. But you can invest in companies that are going to make it through. Starbucks is not going to go anywhere. McDonald's is not going to go anywhere. The only risk you face with those companies is what price you're paying. So if you were in a regular portfolio, let's call it a large cap North American equities, and you own 25%, I would say you have far too little in stocks. And I would say your question was, should you take the losses? And I would say, no, you should increase your equity weighting. You need to outpace inflation. With all of this money printing, there's a good chance that in a few years from now, we might be looking at inflation or hyperinflation. And owning stocks is a great way to combat that. You need to be increasing your lifestyle costs are going up every year, whether you like it or not. So you need to keep pace with that increase. And so, for example, if I own Coca-Cola and the cost of the cost of the ingredients of a can of Coke went up because of inflation, the Coca-Cola would increase the price of the can to the consumer, thereby protecting themselves against inflation. So without knowing much detail, Mike, I'd say that person has too low a weighting in stocks.
Great. Bill, one for you here. What is the market for selling patient lists of an existing practice with no lease, with an office lease?
Hey, there's a real strong market for that. Again, would I be doing it today? I'd wait until we find out when those patients can be treated again. But the defining issue, and it's easy to get caught up in the moment, the defining issue in dentistry across Canada, it doesn't matter where you are. And from the questions, I know we've got people coast to coast here. We have too many dentists and not enough patients to go around. It is more extreme in major urban centers. But if, draw a 5-kilometer radius around your practice, and if there are more than 5 dentists in that radius, one of them will be prepared to buy a patient base. What price gets negotiated, all of those things, that's what happens in any marketplace. But the demand for patient bases is very high. Many dentists are surprised that we can sometimes sell their patient base for more than we can sell their practice. If it's an older practice with older equipment and a high rent cost where they are. So no, it's a great market for selling patients. COVID will not change that.
Great. Mark, one for you here about the last comment around inflation, I believe. Mark, a lot of experts in economics are saying we're going to be facing a deflationary period, not an inflationary period. Does that change your perspective of putting more meat into stock?
It doesn't. The inflation versus deflation versus stagflation debate is yet to be determined. We can't make decisions without having all the information on the pandemic. So we have to have a strategy in place to combat all three situations. The most likely scenario is that we're going to be seeing deflate. We've already seen price deflation right now. We're seeing price deflation. We don't believe that that's going to be systemic or ongoing. But the most likely scenario is actually stagflation, where prices just remain the same for a long period of time. But once the consumers get back to work, there's going to be more money chasing the same amount of goods. There's been more money printed, so the most likely stagflation, and after that a period of inflation. Deflationary would mean that you'd have to start. One of the protections against that would be to go into long bonds, and that would be the last place that I would put anybody's money right now.
Bill, do you anticipate associate remuneration dropping across the board from, let's say, 40 to 30% or 35%?
I think that's that's going to be a function of supply and demand and market economics. That was speculated on in one of the webinars done by by the biggest employer of associates in Canada. And we'd started to see that already. I mean, it's a natural consequence of an oversupply of dentists. I had some U of T recent grads who were working at 35% say to me, hey, Bill, 35% of something's a hell of a lot better than 40% of nothing. So yeah, I would say the laws of supply and demand will suggest that could happen. We haven't seen it broadly. But right now, think of it, if somebody's principal dentist isn't bringing them back because they want to make sure they're filling up their bank account first, that person's potentially going to be prepared to work for a bit less. We have had some of the people registering with us say they're worried about that. I don't think it'll be a broad sweeping issue, but I think we'll see it more and more.
Great. One for you, Mark. Let's see here. Have the laws changed in this have the laws changed around selling a practice to a child? Household practices between parent and child. It says laws in the question, yeah.
I'm sorry, can you repeat the question?
Yeah, they said, have there been any changes in the laws in this direction? I believe what the question is asking is, can you sell between a parent and a child? Is I believe what the question's getting after.
It's the capital gains challenge they're asking about, I think, Mark.
Yeah, Mike, I think you're actually the best person to answer that. We actually structured the we actually had a son or a child purchase this practice. That's what you're talking about, right?
I think that's what the question's about. And I guess the answer would be, so I'm a CPA by trade. You are able to sell between parent and child. There's no restrictions on that. As far as the capital gains exemption go, you can also claim the capital gains exemption. The reason why it's not often used is it's penalizing to the child because they have to pay the large amount of loan on an after-tax basis. So the family as a unit is better off if there's a different type of practice transition, which we've used before, that doesn't involve the lifetime capital gains exemption. If you do choose to use the capital gains exemption, it often benefits the parent and hurts the child, which is not usually the objective.
It brings up an interesting point, something Mike and I were talking about earlier. For those of you that don't know, Mike's my partner. But there's a good chance that we're going to see all of this new money printing by governments. The debts have to be repaid. And the attendees on this call are probably going to be the target of CRA for increased taxes. I think post-war, like we got up to like a 91% tax rate that was in the US. And Mike, you were talking a little bit about the capital gains inclusion rate possibly changing, right?
Yeah, it seems to be a logical political target, I guess. So just quickly framing that, typically only 50% of a capital gain is included in your income for tax purposes, but that hasn't always been so. In the 90s, it got up to as high as 75%. And so when you look at a government that's printing money and needs to collect revenue in order to maintain its, debt to GDP balance, it's fairly easy to politically put through an increase to that inclusion rate up to 75% to collect those tax dollars in an environment like this, because who better to tax than people who are making gains at this time? So that's really going to make the lifetime capital gains exemption and your structure around your practice sale more and more valuable should a change like that become reality.
Yeah, I should say that a small asterisk, that $165,000 case study where that Dr. Smith that we used, the practice was sold tax-free, 1.55. We were able to multiply the capital gains exemption and get all of that money tax-free, if anybody's wondering about that.
Bill, we'll take a few more questions here, guys, and then we'll wrap things up. Maybe we'll go another 5. I know we're over time a little bit. Just one of the questions here was, will this be sent out after the presentation? Like, it's a great presentation. I want to watch it again. It is being recorded, and we will send it out for everybody to see after the presentation. The question for Bill: what is the trend on specialty practices, ortho practices in particular?
The trend on specialty practices in general. Specialty practices are harder to sell than GP practices. Fortunately, that I'm assuming the person asking was an orthodontist, and orthodontic practices have bucked that trend to some degree. So have pedo practices. And I think it's too early to say what the full impact of coming regulations are going to be. I've had very different points of view from orthodontists about the level of aerosols they generate and how it's going to be managed and this and that. I think the broad comment I had earlier will hold, that at some point in the future, we'll be back to very conventional valuations, and a well-run specialty practice where the owner can do a transition to a new owner over a longer time period than a GP practice. There's still going to be a very good market for. I wouldn't be rushing to sell one right now, but I've got 2 perio practices right now. If there are any periodontists on the call, call me. If you want to buy a practice, I've got enough to sell. We've just got things on hold right now. And we're going to be right back as soon as we know what the ramp up looks like. And both of them, I'm very confident we're going to get pricing that's quite similar to what we would have had before. And if not, they're just going to wait until we're up that confidence curve to the point where they can. So I think orthodontists, you're going to be fine. Pediatric dentists, you're going to be fine. The rest of the specialties, if you're in a group practice, you're going to be fine. And if you're a solo practitioner in a heavily referral-based specialty, get working on a plan now, even if you're 5 years away from selling, because that's the kind of time you need to plan to get a good outcome.
One thing we haven't talked about, and Bill, I'm interested to hear your thoughts on it. I wrote an article for the ODA at the end of last year talking about the indebtedness of part of the article was called "The Illusion of Financial Success in the GTA," and that Canadians entered this recession with far more debt than any of the G7 nations. Dentists, so there is a cohort of dentists that were highly leveraged. So these people are, one possibility is to see some necessity of sales coming from these people as well. Do you agree with that?
Yeah, we've already started to see that. We've been approached by 1 or 2 people. I would say that the most common situation would be multi-practice owners right. whose plan was predicated on reasonable forecast, and they've now gone through at least 2 months and who knows how much longer with rent bills to pay. And costs to pay, and there will be people who hit liquidity trouble. generally the individual owner operator, the bank is going to support you. No matter how tough it is. They know that the only way they're getting their money back is to keep your practice in operation and keep you motivated to keep it going. But multi-practice owners, we've been approached by a few who want us to sell one so they generate some liquidity. I think that's something we are going to see going forward. Some of them will sell out to the corporate aggregators who have the money on their balance sheet. One we were approached by said, hey, I think I'd be prepared to look at liquidating all of my practices, but I think I'll get more given the motivation of individual owner operators if I sell them individually. So there'll be some of that.
Yeah.
So I think we're running near the end of our presentation. We are going to probably run short and not get to all the questions today. So I'm just putting back up the slide of Bill and Mark's phone number. Bill, are you seeing that on your end? Did I do that properly?
Yeah. Just let me add, because I can see we've got a ton of questions that I would love to answer. I think we've got your email addresses. If we do, I will everyone addressed to me. I guarantee you. It may take until the long weekend for me to get back to you, but I'll get back to each person when we've got the email address. If you want the slide presentation, the email Mark or I think we're going to have a recorded version. None of us can over communicate enough right now. If you've got a question, I know I'm speaking for Mark and he'll echo this. If you got a question that we didn't answer, by all means, chase us down, text, phone, email.
I think what's going to be interesting too is just to stay in touch. And Bill and I are, available. We don't have all of the information, just like nobody else has all of the information right now. So we're continuing to communicate with all of our colleagues, and the more we learn, the more we'll share. So please reach out.
Great. So I think that concludes our presentation for today. As you guys are saying, we're living history, and I hope everybody keeps in touch as the information evolves. We'll evolve with it. Thank you for joining us, everyone. This was Bill and Mark. Great presentation. You guys have any closing remarks?
Nope.
Nice.
Have a great, hey, everybody. It's been hell on all of us. Have a great long weekend.
Enjoy it.
Great. Everybody
take tomorrow off. Don't go into the practice.
Thanks, everyone. Talk soon.
Bye.
Take care. Bye-bye.